I have come across people saying that indicator trading isn't good enough and that technical indicators are the wrong tools that traders use. People have argued that indicator trading is inaccurate as it is based on past price data and that it is lagging. But is this really the truth? Let us find out. Hello and welcome to Forex Monopoly. My name is Daksh and in this video, I am going to bust some most common myth about indicators and indicator trading as a whole, and also I'm going to share the perfect way to use indicators, so make sure you watch this video till the end. Now before we move any further, I just want you to brief about what indicators actually are. So indicators basically are the tools that technical traders use to get buy and sell signals and then capitalize on the price swings. Technical indicators are mainly a set of calculations and formulas that are applied to the past price and volume data to generate signals which traders use to take trades. So, do all indicators lag, or as many traders claim that indicator trading is worthless? Is it really true? I think no, it is not. All indicators do not lag, and indicator trading is indeed highly profitable. It is just that you have to understand that there are different types of indicators and then you have to use them accordingly. So there are mainly two different types of indicators, the leading indicators and the lagging indicators. Leading indicators are those types of indicators that take into consideration what is happening at the moment, which can influence the price. And lagging indicators deal with the things that have already happened in the past, and it then studies the past in order to find something that can influence something in the future. So both of these indicators have different purposes, and if it is used accordingly, only then you might be able to use it properly. I am sure that by now you must have understood what indicators are and that all indicators aren't the same. Now, before I move on, I want to ask you a question. How will you determine who will win a football match or even a cricket match? I am sure that you would look to study past data of how players performed against various teams and in different market or different match conditions. And you will try to analyze the different factors in order to arrive at a conclusion. And this is what a lagging indicator does. Now, what if I ask you which player is going to be substituted in the football match? To answer this, yes, you can fetch data of how the team manager normally makes substitution, and you can find out which player has the manager always substituted between the match. But this approach might not always work. So in order to know which player will get substituted, you will have to see which player is performing badly in the match and might be a liability for the team. And this can be done only if you are watching the match and you know which player is playing up to the mark and which one is not doing good at that moment. And this is exactly what leading indicators do. So these are the two types of indicators and both work just fine. You just need to understand which one to use and where to use it. So before you apply any indicator to the price chart, you first need to know about the indicators that are at your disposal. And you also need to know what exactly you are looking for. My point is, you cannot use a tool unless you know the right way to use it. Like if someone gave you a measuring tape to measure the weight of something, then I am sure you will laugh at them. In the same way, if a trader uses a trend writing indicator for getting reversal entries, then he may not like the results which that indicator gives. Like I mentioned earlier, that different indicators have different inputs and outputs, and they should be used only in the right conditions that are favorable to them. Like, let us consider moving averages. Do you think moving averages will be better in the ranging market conditions over trending market conditions? Absolutely not. Moving averages are made to be a trend riding tool and should only be used that way. Now, if you want an indicator for ranging market or ranging market conditions, then you should use the RSI indicator for divergence. Yes, you can spot a divergence on the RSI indicator that made you enter on a reversal, and it is quite possible that this reversal becomes a full-fledged trend. Now that you know which kind of indicator should be used in which type of market conditions, you should know whether the indicator is a leading indicator or a lagging one. Like RSI divergence is a leading indicator as it gives you a trading signal based on what exactly is happening in the market at that particular moment. And you can use it to get reversal entries. Now, I have already added a video on RSI divergence. So if you haven't watched that video yet, you can check it out by clicking the I button. Now, when it comes to moving averages, it could be both a leading and a lagging indicator based on how you use it. Like if you take a moving average crossover signal, then this will be a lagging indicator because this time what you are doing is you are using it for finding reversals. And by the time crossover happens, the price will have already moved on or moved ahead. But if you use the moving average to trade pullbacks and continuations, then you have a leading indicator at your hand. Like you can buy or sell when the price approaches the moving average and hence right trends. So now you see that indicators are not really lagging. It depends upon how you are using it. Look, my main intention for this video was to tell you to stop falling for such myths, be it trading or in life in general. There will always be someone or the other saying things and giving rise to myths. And there could be two things here. Either they haven't used it yet and they don't even know what they are talking about, or maybe they used it but not correctly. Hence, did not get what they were expecting and choose to say negative things about it. Now, whenever you hear any such claims made by people, you should first understand on what grounds are such claims made, and if possible, you should test things out for yourself and then you should arrive at a conclusion. Now, I have heard a lot of people say a lot of negative things about moving averages, divergence, and other things in trading. But did it really stop me from making money through it? It did not. And instead of falling for such myths, I want you to try it for yourself and then decide. What if you fall for such myths and do not try it out yourself, and you might just miss out on the very thing that can make you a consistently profitable trader. And this is too big a risk to take.